Introduction to the stock market. The stock market is a centralized marketplace where investors buy and sell shares of publicly traded companies. It provides a platform for companies to raise capital by selling ownership stake shares or stocks to investors and for investors to potentially profit from the success of those companies. Primary and secondary markets. The stock market consists of primary and secondary markets. In the primary market, companies issue new shares to raise capital through initial public offerings, IPOs. These newly issued shares are sold to institutional investors and the public for the first time. Once shares are sold in the primary market, they enter the secondary market, where investors buy and sell them among themselves on stock exchanges or over-the-counter OTC platforms. Stock exchanges. Stock exchanges are organized markets where buyers and sellers come together to trade securities. Examples of major stock exchanges include the New York Stock Exchange, NYSE, Nasdaq, London Stock Exchange, LSE, Tokyo Stock Exchange, TSE, and Shanghai Stock Exchange, SSE. Exchanges facilitate the trading of stocks, bonds, derivatives, and other financial instruments through a regulated and transparent process. Participants in the stock market. Several types of participants operate in the stock market: investors, individuals, institutions, and organizations that buy and sell stocks for investment purposes. They may include retail investors, mutual funds, pension funds, hedge funds, and other institutional investors. Issuers. Companies that issue stocks to raise capital in the primary market. They include publicly traded corporations, government entities, and other organizations seeking to finance their operations, projects, or initiatives. Brokers and dealers. Intermediaries who facilitate trades between buyers and sellers in the secondary market. Brokers execute orders on behalf of clients, while dealers buy and sell securities from their own accounts. Regulators. Government agencies and regulatory bodies responsible for overseeing the stock market and enforcing rules and regulations to ensure fair and orderly trading. Examples include the Securities and Exchange Commission (SEC), the United States, and the Financial Conduct Authority (FCA) in the United Kingdom. Market makers. Specialized firms or individuals that provide liquidity to the market by buying and selling securities on a continuous basis. They help maintain orderly trading and narrow bid-ask spreads. How stocks are traded. Stock trading involves the buying and selling of shares between investors. The process typically follows these steps. Order placement. Investors place orders to buy or sell stocks through brokerage firms. Orders specify the quantity of shares, price, and type of order: market order, limit order, stop order, etc.
Order routing. Brokerage firms route orders to stock exchanges or alternative trading platforms where the stock is listed. Orders can be executed electronically or through floor trading open outcry on the exchange floor. Order matching. Stock exchanges match buy and sell orders based on price and time priority. Trades occur when a buy order matches with a sell order at the same price. Execution and settlement. Once a trade is matched, it is executed, and ownership of the shares is transferred from the seller to the buyer. Settlement typically occurs a few days after the trade date, during which funds and securities are exchanged. Factors influencing stock prices. Stock prices are influenced by various factors, including company performance, earnings reports, revenue growth, profit margins, and other financial metrics impact investor sentiment and stock prices. Market sentiment, investor perceptions, confidence, and market trends can influence buying and selling behavior, leading to fluctuations in stock prices. Economic indicators. Macroeconomic factors such as interest rates, inflation, GDP growth, employment data, and consumer confidence can affect stock prices and market sentiment. Industry trends. Developments and trends within specific industries or sectors can impact the performance of related stocks. Global events, geopolitical tensions, natural disasters, regulatory changes, and other global events can create volatility in the stock market and affect investor confidence. Supply and demand. The basic economic principle of supply and demand also applies to stock prices. When demand for a stock exceeds supply, its price tends to rise, and vice versa. Types of investment strategies. Investors employ various strategies to achieve their investment objectives, including long-term investing, buying and holding stocks for an extended period, typically years or decades, with the expectation of capital appreciation and dividends. Value investing. Identifying undervalued stocks trading below their intrinsic value and holding them until their true worth is recognized by the market. Growth investing. Investing in companies with strong growth potential in terms of earnings, revenue, and market share, often at higher valuation multiples. Income investing. Focusing on stocks that pay regular dividends to generate a steady stream of income, particularly for retirees or income-oriented investors. Day trading. Buying and selling stocks within the same trading day to capitalize on short-term price fluctuations. Day traders often rely on technical analysis and leverage to make quick profits.
Conclusion. The stock market plays a vital role in the global economy by facilitating capital formation, investment, and wealth creation. Understanding how the stock market works, its participants, trading mechanisms, factors influencing stock prices, and investment strategies can empower investors to make informed decisions and navigate the complexities of investing effectively. Whether you're a novice investor or a seasoned trader, staying informed, disciplined, and focused on your investment goals is key to success in the stock market.